so much.
I'll be in touch. Okay,
Great.
take care.
Thank you.
Great. Thanks. So hi, everyone. I'm Ann Brown, and it's about 2 minutes before noon, and we should probably let people log in. All right. I'm going to need to figure out how to pin my screen because y'all keep moving around. So
Every
Chad,
time somebody read,
just for
every time,
sorry, say that again.
I was just gonna say, I think every time a new person joins, it remakes the grid.
Got it. So while we wait, Chad, just for fun, how many Zoom meetings have you been on in the last 2 weeks?
Well,
Not with me.
I would extend that maybe to 3 weeks, but it has been, literally 10 hours a day, just either on the phone or Zoom or Microsoft Teams. So it's been interesting. It took a little while to get used to it, but I think we've worked out most of the kinks. But it's been nice to connect in this way. Certainly better than just over the phone. So it's worked out all right.
Yeah, I think people overall are kind of warming up to the concept of video conferencing just in general, because they've discovered when they're forced to use something, it's like you discover how easy it is, So there's a lot of people right now that are just, for us, we're just using Microsoft Teams all the time instead of picking up our cell phones, which is,
Right.
It's just so much easier, and it, saves the battery life or whatever on your phone, and it's just easier.
Yeah. We did have a note from our IT guys, though, who may or may not join us today because Jeff usually is at our meetings, that be careful not to use Microsoft Teams for anything that needs to be archived because it's not backed up. It really should just be for those check-ins or quick dialogues back and forth. But anything that you want archived, you still should email because your email is backed up. So I thought that was interesting. I hadn't heard that about Microsoft. We literally just started using Microsoft Teams like 2 days before we went into I sent everyone home. Like it was and it's been a big learning curve.
Yeah.
Yeah.
One of the things.
Go ahead. Sorry. Yep.
One of the things I did is I created a daily check-in channel. And so we're a small firm. We have 22 people right now. And so we can check in every morning. And I was showing Susan, like, I have a little attendance sheet. So I check to make sure that everyone's here, or I know if they're taking time off, because we have had a couple people have to take time off as well. So
one of the things we just started using within the Teams is you can do a poll of everybody that's participating.
That's a good thing to know.
There's a couple of apps. I think that particular one is it's called Forms. So within the app Forms, you can just very easily create a poll. So if you're, we were just trying to pick a date for a virtual social, and so you could just have everybody thumbs up, thumbs down really quick, or actually do a poll to choose what date worked best. So it was very easy to set it up. So it was good.
That's fun, but then people can't put in the little emojis or pictures or different like memes of things.
Right.
Which is what our daily check-in has turned into, basically. It's really interesting to see people's creativity. We've also done this thing where somebody posts a question of the day, or just for fun, like, show us something that's in your house that you think is interesting. And that's been really kind of cool too. All right, we're at 12:02. Should we give people a minute more? I'm not sure how to tell how many people are on.
Count the tiles.
I'm not
21.
really.
I see 21.
Okay. Well, 35 people responded to this, which is a record. So thank you for everyone who's here and listening or showing. You can, everyone's starting on mute. And then if you have a question or something, we'll have some time, but I'll start just by saying, hi, my name is Ann Brown. I'm the finance director at Schwartz Silver Architects. I co-chair this meeting every 2 months with Tracy from ArcUSA, who will be joining us hopefully a little while later. She had a Zoom conflict with her team today, which, as we were just talking earlier, that happens with all of these Zoom meetings. But Susan really encouraged us to have a check-in and to do this virtual meeting in place of our regular meeting, just to keep our community together and have people give them the opportunity to say hi. So it's really nice to see some of you, and to sort of circle around on something that I've been spending an enormous amount of time on, and Chad can attest to it, the CARES Act and specifically the PPP loan program. Chad and Rick, why don't you introduce yourselves and then maybe you could start?
Sure. Well, hi, everyone. So my name is Chad DeGrasser. I'm a partner at DGC. So we're a full-service CPA firm that specializes in working with architects and engineers. And, obviously have spent a lot of time over the last couple of weeks helping firms both apply and anticipate the forgiveness amount under the PPP program as they put together their cash flow projections for the next period. So certainly looking forward to talking with all of you and seeing how you've adapted to this new environment and answer any questions that you have regarding the program. So Rick?
Yeah, so my name is Rick Strout, and I'm a principal at DGC, and I work with Chad as part of the A&E team that we have in place at DGC. And to echo what Chad said, the past 3 years has been very very action-packed, I would say, in terms of helping clients get to the place on these loans where they need to get to, and helping them also with their cash flow projections, just given the crazy times that we're in. So happy to be here today to discuss these issues further with you folks, and looking forward to it.
So I just want to remind people too that there's a chat button down at the bottom that you can open up. So if you have questions while we go through that you want to pin there or remark, I asked Chad to just do a quick update about the PPP program, and then we can open it up to questions. Is that okay?
Sure. Yeah. So Rick and I will just sort of go back and forth, and then so what we thought we would do is just give everybody a brief recap on the rules surrounding the loan amount and how you calculate the loan amount, just so everybody is clear on that. Hopefully, by this point, all of you that were interested in the loan have submitted your applications. So we just wanted to give you a brief update on the rules there. And then spend a little bit of time just talking about the loan forgiveness period, and just some things to keep in mind as you're starting to, once the funds come in, things you just need to be thinking about as you're dispersing those funds, so that you can hopefully maximize the loan forgiveness amount. And then certainly open it up to questions. So Rick, do you want to just go through the loan application amount and the calculation in terms of the current guidance?
Yeah, sure. So the loan, the guidance came out, I want to say, well, first of all, the act came out about maybe 2 or 3 weeks ago. And it contained a lot of very ambiguous, confusing, and contradictory language in terms of how you calculate the loan amount. And specifically, there was confusion over there's been a lot of talk about $100,000 cap on compensation, and whether or not that cap applies to each employee's salary and wages, or whether that cap applies to an all-in payroll cost or compensation cost. So we wrestled with that for about maybe 5 days, and finally some additional guidance came out from the SBA and from the Treasury Department. So if you were to go on to treasury.gov, if you looked at the FAQs, they've got a series of FAQs up there on their website now that basically helps you understand what the definitions are in terms of how you can calculate the loan amount. So generally speaking, the loan amount is equal to your average monthly payroll costs multiplied by 2.5 or 2.5 months. And so payroll costs would be defined as salaries and wages. And again, you apply a $100,000 cap per employee against those salaries and wages. And then in addition to that, you can add in your health insurance costs, any retirement benefit costs, and then certain Massachusetts taxes that are based on employee compensation. So that average, if you will, is calculated and then multiplied by the 2.5. And then the other big question that we had and that we wrestled with, that we finally got some guidance on in the past week, is when you're calculating an average payroll cost, or average monthly payroll cost, I should say, the act says that you need to use a look back period, a 12-month look back period, in order to figure that out. And it was initially very unclear to everybody as to whether or not you can use 2019 calendar year as your look back period, or whether you can use, the last rolling 12 months from the date of the loan. So in other words, for most people, that alternate date would be April 1st, 2019 through to March 31st, 2020. So, and there's a lot of confusion in terms of the banks and what they were requiring, and the guidance finally established the fact that you can use either date, and it should be at the option of the borrower. But I'm not sure whether or not the banks are complying with that. Chad, have you heard anything about that?
It's, I think it has varied from bank to bank. And
Yeah.
so I think, obviously the recommendation would be whatever your bank is requiring, use that. If they are saying we want you to use calendar, then just go with calendar. I know Bank of America, for example, when you complete their application, they want to be able to tie the amount that you're requesting to the 940, because it says in the application, include the 940, take the amount from your 940, put it here, and then reduce it for the people that are over $100,000. So I think it is bank specific. And it just might be a harder road if you choose to use something that your bank is not sort of advising you to do.
Well, yeah, and it's hard because it's a tough situation to be in, because calendar year 2019 is probably the easier of the two methods to go with, just in terms of logistics and calculating, crunching the numbers. But you need to also remember that it's a situation where your time is of the essence, and we all know that. And so it's a situation where you don't really want to push back on your bank too hard. In other words, just kind of do what they say, just because they're kind of the key holder, or the gatekeeper, I should say, to these funds, and it's very important that businesses get their hands on this money before it dries up. And by the way, as of yesterday, I should mention that I think I read that there's been 6 business days since banks kind of started accepting applications on this, and in that time, they've gone through and approved 225 billion of the 349 billion that's available. So in 6 days or so, 2/3 of that funding has been committed to businesses. So really, time is of the essence here.
So before we move on, I have a question about once you've put the application in, now it's in your bank's hand. In our case, it's Citizens Bank. We've gotten one email for clarification and uploads, which we did. And then we just get these every other day, yeah, we're working on it kind of emails.
Yeah.
What's the process behind the scenes? What are they doing to get that to the SBA and approved?
So
You
the,
know?
the banks are, so they are required, the regulations are a little loose. I've talked to a couple of the banks, and I know Rick certainly jump in as well. So the SBA has sort of delegated all of the sort of underwriting, the vetting to the banks. And so the banks are internally trying to comply with their own internal standards, because ultimately the guarantee of these loans, it's 100% guaranteed for the first year and then 75% guaranteed by the SBA in the second year. So there is some exposure to the banks. And so they want to make sure that they're following their internal standards, and they're trying to figure that out on the fly in terms of what is the documentation that they want to see. And so I think for those of you who have yet to hear from your banks that the loan application has been submitted to the SBA, it's because they're still internally trying to figure out, have they satisfied all of their underwriting requirements, and do they have all the information that they think they need to be able to satisfy their internal regulations so that they can submit it to the SBA. Some banks have been faster at that than others. I think some banks have taken a more conservative approach, asking for a lot of documentation. Other banks haven't asked for all that much. So it really does vary bank to bank. But I think the key, as Rick just pointed out, is to make sure that you are communicating with your bank and really trying to understand, when is your loan going to be submitted to the SBA, because that's the key trigger here. Once it's submitted to the SBA and the SBA receives it, the funds are sort of allocated not that you're guaranteed the money, but the loans are sort of, the amounts are set aside so that money can't be allocated twice. But if it doesn't get to the SBA, it can be allocated to somebody else. And so you just want to continue to make sure that you're staying in touch with your bank and you're providing them with as much information as they ask for so they can get your application in.
And I have heard that as of Friday, the money has started to flow, so to speak, as they say. So that's a very good thing. In other words, the SBA or the banks have started to release that funding to actual customers. That started happening on Friday.
Right.
So again, to Chad's point, just keep communicating with your contact at the bank to get the latest and greatest, and that's really all you can do in this kind of a situation.
Yeah, I describe him as my new best friend. So, yep.
As you should.
I got him on speed dial on my phone. I got him on my, but so the other question that I had was, some people have said that if you don't have an already a relationship with a lender in a lending form, like you don't already have a line of credit, you don't have a loan with a bank, that they're not prioritizing those people. Is that true? Have you heard that?
I have heard that, and I think, again, different banks have different answers to that. I had one client that was really struggling with their institution to just get the application in, and they just couldn't do it. And so we were able to put them in contact with another bank that was able to get the application in. And so I think it all depends on the company, the size of the company, sort of helps in this situation to the bank. If the bank sees this as a client going forward, that's going to be a good customer for the bank, that sort of helps as well. So I would say that, if there's any firms out there that have not been able to get an application in because they just can't get, they can't get their banks to give them the necessary guidance, I certainly would talk to other banks, talk to your advisors, and try to find other banks, because there are banks that are willing to talk with those companies and see if they can work something out. In this instance that I had, the client basically moved all of their banking relationship to this bank. in order to move forward on the PPP application. But they were so frustrated with their current institution that they were going to move anyway, just because
Yeah.
they weren't getting any help at all. So
Yeah, and the banks were frustrated, just as frustrated with the
Right.
SBA,
right,
just
Right.
because there was such a lack of initially of guidance for the lenders to follow on their underwriting standards and the logistics of it and everything. So so that there was kind of a trickle down effect, I think, in terms of the frustration level going down to the customer level.
So Rick, of the banks that you've heard that are the money is flowing, are they large banks? Are they small banks? Is there some logic to this, or is it just random?
What I heard was very anecdotal and it wasn't specific in terms of, but I would imagine that most banks as of now are starting to fund these loans. So I wouldn't think that if your application is in, I wouldn't think that you would have to wait too much longer. Keep your fingers crossed. But so to answer your question, no, it wasn't really based on any specific bank that I had heard the money was flowing, but it was just a general comment.
Great. So then let's move to the what happens when we get it. I did have the privilege of listening to your podcast or your webcast last week with the BSA, where the one piece that I hadn't heard anywhere before was to open a new bank account to keep track of this. So let's say I hear today, yay, that some good news. What do I do next?
So what you do next is, number one, make sure those funds hit that new bank account. And, we're recommending that every client do that because it leads to a better trail later on for you to just say, show Mr. or Mrs. Banker, here's what I did with the money. So there are certain, there are certain ways in which if you spend the money, it could result in a certain way. It could result in, a reduction of the loan forgiveness. And I think everybody's goal should be to go about this in a way so that you achieve 100% forgiveness on these loans, because everyone loves free handouts. Who wouldn't? So there's a few ways that you need to kind of be careful of, and by setting it up in a new checking account, it'll just allow you to track it in real time a lot better than if you commingle it with your other operating cash. So, and again, the loan forgiveness, the potential for reductions of the loan forgiveness has to do with, number one, you have to make sure that at least 75% of your funds are ultimately spent on payroll costs. So that means that less than 25% of your total loan amount should be spent on non-payroll costs, okay? So the non-payroll costs would be like your rent or your mortgage interest or your utilities. And the payroll costs are defined as salaries and wages, plus your benefits like retirement benefits and health insurance. Okay, those are the big ones. So, and that's measured over an 8-week period from when you get the loan. So you get the loan on today, you have 8 weeks to sort of spend it. So that's number one, 75% has to be on payroll costs. And then number two, it can be, the loan forgiveness can further be reduced by the extent to which that you reduced your staff. So what you do is you take your average monthly full-time equivalent employees, and that's a definition we should circle back to, is there's a big debate still about what FTE means. So if you reduce your staff, say by 10% during the crisis period, which is really from, I have it written down, or it's the covered period, I should say. So if you reduce your FTEs per month during the covered period, which is the 8-week period, say by 10%, then, as compared to the FTEs before the crisis, then your forgiveness gets reduced by 10%. Okay. So if you've got layoffs, you've got to really be careful. The big incentive here for this loan program is to give employees an incentive to not lay off people. And then the third way that the forgiveness gets potentially reduced is if you reduce a person's salary. You don't lay them off, you keep them on the payroll, but say you reduce their salary by 40% or 30%, whatever. You're going to take a hit on your loan forgiveness for that as well. However, in the Act, there is a cure provision, C-U-R-E, cure provision, where if you reduce your staff during this 8-week period, but then you bring them back in time for June 30th, then you're good.
And just
So,
a
and
couple of
just-
things that I would add to that. Anne, go ahead if you had a specific question.
No, go ahead. You go first and then I'll ask after.
Yeah. So I guess just a couple of things that I would also add. So in relation to setting up the separate checking account, that can be a little bit more complicated in some areas. So at a minimum, we would certainly recommend that you set up a separate GL account to track the cash coming in and then the cash getting dispersed out. And that's a minimum. If you already have a couple of bank accounts with the bank, let's say you have a savings account and a checking account, one thing that you could do is take whatever balance is in your savings account before you get the loan proceeds and just move it, transfer it to the checking account. So that account starts at 0. Then the loan proceeds come in, move it to that account. So that's where it starts. And then when you're going to pay, whether it's your payroll, your rent, utilities, if you pay it out of your normal checking account, you can just do a transfer from the savings account to the checking account in the exact dollar amount. And I wouldn't commingle it. Just every time you make a transaction, do it for the exact dollar amount. And then you can clearly show that that money is what was earmarked and what was coming out of your checking account. So hopefully I articulated that clear enough. But, again, it doesn't have to be that you wrote the check against that account. You just have to be able to connect the dots for, any type of auditor or agency that would be looking, at how you use the funds. The other thing that I would just remind everybody is that $100,000 cap that Rick mentioned also exists over this 8-week period. And so if you just take $100,000 divided by 52 weeks times 8 weeks, and we're still waiting for guidance from the SBA on this. So, that's a big qualifier with everything that we're saying is that we're still waiting for guidance. But theoretically, right now, the most that you can pay to any one individual over that 8-week period is capped at $15,385. So that's $100,000 divided by 52 times 8. So you still have to keep that $100,000 cap in mind as you're going through utilizing these funds, calculating the forgiveness, because that is still there. And again, that's on the salary costs only. So you'd get to add, retirement, health on top of that. But that cap is something you want to just make sure you're keeping in mind.
And because of that, depending upon, the salary levels of each particular company, that itself may make the 75-25, ratio really tough to hit. Right?
Right. And the other thing that again, we're still waiting for guidance on this, but for some firms, when they calculated their loan amount, included in that 12-month period was bonuses to staff that were not making an annual salary above $100,000. And so you could add bonuses to their amount to get them either closer to $100,000 or to that $100,000 cap. But if you based your loan amount on, let's say somebody was making $70,000 a year and they got a $10,000 bonus. So if you used $80,000 for purposes of the loan calculation, but their base salary is only $70,000, if you then use that $70,000 over that 8-week period, you're not going to get there because of that $10,000 bonus that happened at the end of the year. So one thing that, you know, we're looking at as we're helping firms walk through this forgiveness calculation is, and obviously there's a lot that goes into these decisions in terms of the level of working capital that you have, what your prospects look like for cash flow, things like that. But some firms are looking and saying, well, the only way that we're going to be able to maximize this forgiveness is to almost do a bonus during this 8-week period to those staff members that are making salaries less than, or else we won't be able to maximize the loan forgiveness. And so again, we're still waiting on the guidance to see whether they're going to prevent any of that sort of bonus money to happen, or is it just straight annual salary? But, you know, that is something that I would certainly have some plans in place that if the guidance does allow those bonuses to be paid, if that's the only way you're going to be able to maximize the loan forgiveness, that might be something that you have to be ready to think about.
And the other part of this is that, you know, if you're struggling to, I guess, fully utilize the loan amount because, you know, you need to get up to that 75% level, if you can't do that without bonusing certain employees, to Chad's point, at the end of the day, the worst possible situation on this program would be that you'd have to give back, you know, whatever you don't use, which, you know, isn't the end of the world, really, because it was a loan and it turns effectively it would turn into a loan, and, you know, you'd want to pay it back, and particularly since, you know, there are no prepayment penalties on this loan. So that's really kind of like the worst possible situation that you could be in on this, I think, is you just have to give back a piece of the loan that you had.
And there are some questions in the chat, but I didn't know if you had, because you had a question, so I didn't know.
It was about that cap, because I've talked to some people at other firms who are reducing their highly compensated employees, people who make over $100,000, bringing them down closer in line with that, so that when and if this, both for cash flow purposes, for planning purposes, but also recognizing that in this program, that's the most you're going to be able to claim. And did that make sense? And I think based on what you just said, it does.
Yeah. So just to, you know, clarify the cap amount and how that relates to the loan forgiveness. So within the act, you can reduce salaries by up to 25% without jeopardizing any of your loan forgiveness amount. But that 25% reduction only comes into play once you're below that $100,000 cap. So you could take somebody theoretically that's making $175,000, you could bring them down to $100,000. And even though that reduction is more than 25%, that's not going to hurt you for purposes of the forgiveness calculation because they're still above that $100,000 cap. So that 25% threshold that you can work within for purposes of the forgiveness really only comes into play once you're starting at that 100,000 and going lower. So that's so yes. And what a lot of firms are doing now to save capital is looking at their compensation structure. Some firms are just doing across the board salary cuts to all levels. Other firms are tiering it. So the higher level people are taking a more substantial reduction than some of the lower paid positions. But they're all sort of looking at salary reductions as a way to conserve cash.
And then the other question is, I wanted to circle back to the FTE question, Rick, that you said we should come back to.
Yeah. So basically, there's no guidance in terms of what the actual definition of an FTE is. And you know, if you look at government for guidance, you know, under the Affordable Cares Act, the definition of an FTE was someone who works at least 30 hours per week. If you look at the GAO, the Governmental Accounting Office's definition of an FTE, it's anyone who works over 40 hours per week. There are many, I think that we've spoken to a few attorneys on what they think the definition is going to be. And most say that it's probably going to follow the ACA, or 30 hours per week. But if you do the math on you know, your FTEs using 30 hours per week during the crisis versus 30 hours before the crisis, you're going to end up in the same place in terms of a percentage decline. In other words, that percentage is going to be the same whether you use 30 hours or 40 hours, I think, as long as you're being consistent with your calculation.
Yeah, and
Does
in
that make
terms of the base period for calculating the reduction in headcount or FTEs, and Rick, certainly correct me if I have this wrong, but essentially the company can choose 2 periods to look back at.
Yep.
And then you're going to compare what your average headcount was over that 8-week period to either of those 2 look back periods. And so those 2 look back periods, the first one is February 15th, 2019 to June 30th of 2019. So that's the first look back period. The second look back period is January 1st of 2020 to February 29th of 2020. So you calculate your average FTEs under both of those look back periods, and then you choose the lower one. You want to choose the one that's going to produce the lower FTEs that you have to compare to the 8-week period, because that would just give you more flexibility in the calculation. So if you ran the numbers from February 2019 to June 30th of 2019, and you came up with 30 of a you know, FTE calc, and then you ran it from January 2020 to February 29th, 2020, and you came up with 25, you would use the 25 because that's going to be the lower number.
That's your denominator.
That's your denominator. You compare that to the full-time equivalent headcount over the 8-week period. And that's any reduction from that 25 is going to count against your forgiveness amount.
And that's what I was kind of just conveniently referring to as the before the crisis, you know, headcount number.
Right.
Before the world got
And now we can
crazy.
get to one of the questions in the chat, which I have as well. We have someone who's on maternity leave who her last pay period was paid maternity leave was March 28th. So if I get the loan today, she's not, I mean, is she still employed even if she's not paid?
I believe so. Again, we're still waiting for that guidance, but technically they're still an employee. They just might be out on FMLA coverage. So it shouldn't count against you in terms of the head count calculation because you have not terminated the position. They're just out on FMLA if they're out on, you know, some sort of family leave. So I don't think that that's going to hurt or count against you for purposes of the FTE calculation.
And clearly we intend to bring her back before the end of June. So that's,
Yep.
as long as that happens, I would think it would be okay.
Mm-hmm. Then there was another question there. How do you transfer exact amounts if we need to deduct the $100,000 cap? And so the easiest way that I would explain that is let's say that you run a bi-weekly payroll. And so let's say that you just, for purposes of this example, you just have one employee and they make over $100,000 of annual salary. So if you take $100,000 divided by 26, that's $3,846. So that would be the cap that you can pay that person using these loans. Let's say that the person makes $4,500 in terms of actual salary. So what we would recommend is that in that new bank account that you set up, or you use an existing bank account for these loans, you pull out $3,846 for that payroll run and shift it over to your checking account. And then you just take the difference between that $3,846 and the $4,500, and that's going to come out of your regular checking account. And in total, the $4,500 is going to come out of your checking account to pay the payroll, but you're only going to fund $3,846 of that $4,500 from the PPP loan. And so what you want to just clearly show is that you're transferring $3,846 from the PPP loan account for salary for this pay period for that person. And then when you ultimately pay that person the $4,500, you just document that that $4,500 is made up of two components: $3,846 from the PPP loan, and then the additional amount is from other cash, that you had on hand. And so that's the way that you sort of have to track it through your accounting system and through the accounting of these funds. And you really want to make the trail of breadcrumbs as easy as possible to follow, because we just don't know if there's going to be an audit, to what level of detail they're going to want to see. Our assumption is they're going to want to see it to the penny. And so that's what we would recommend.
Yeah, which certainly creates, additional administrative burden because someone has to keep track of all that and create the good system and the good trail to Chad's point. But at the end of the day, it'll be worth it because the loan will be forgiven. It really turns into a grant at this point from the government.
So one more question. I know when we started, you were recommending doing 13-week rolling forecasts. Are you still?
Cash flow.
Yeah, for cash flow purposes. Is that still our time frame, or are we looking longer now that we know that we're probably going to be in for at least, I'm going to go out on a limb and say another month?
I think the key to that is that it should be a rolling 13 weeks, right? So if you go into the next week, you create an additional week on the back end of that projection. So that I've found that 13-week time period, when it's rolling like that, it gives you a good flavor in terms of, what kind of weekly collections I need to maintain in order to pay X amount of vendors, et cetera. So I would recommend that you stay with the 13 weeks, but if you want to go longer, then that's certainly up to you and your comfort level.
Yeah, I think, so I would agree with that. I don't think there's any harm in going longer. I think once, if you think about 13 weeks, it's really 3 months. I mean, that's effectively what we're saying is you want to have a 3-month cash flow forecast. And that is based on, normal times. And obviously we're in anything but that. And so I think at a minimum, you want to do a 13-week cash flow. Once you get beyond 3 months, visibility gets a little murkier in terms of what you're able to predict. But at the same time, I certainly think it's a good financial habit to try to project out longer than that, because you really want to tie your cash flow projection to ultimately what you think your client payment cycle on average is going to be. And so that's where the whole 13-week cash flow sort of came from is, general business was 90 days, collecting in 90 days. Some firms collect a lot sooner than that. Some firms it takes a lot longer. And so the sort of the average that just became an industry standard was that 90-day collection cycle. And that's really what built the foundation of that 13-week cash flow. But if you know that your clients are taking 120 days to pay you, then you should be using a 120-day cash flow cycle. And that's what you should be using to project your cash, your expenses, so that you can have all the information that you need to make those decisions as you start to look at things need to be deferred or possibly just completely cut because you can't afford them.
Yeah, I've been getting a
and-
little heat from my principals that I've been, I have a 12-month calendar projection and they're getting a little mad at me because I don't want to do the 6 months from now. It's just really hard to predict. I mean, we know that jobs are stopping and we know they'll start right up again as soon as they have the all clear. We just don't know when that all clear is going to be. So
Right.
that's what.
And you can do different pro forma, projections that are based on different types of assumptions. I mean,
That's what I
any
do.
projection that you build is only as good as the assumptions that you put into it. So,
There is another question in the chat, and so this is a sole proprietor without typical payroll. They've yet to hear on whether their application has been approved, and they're sort of wrestling with, do we just file for unemployment? If you're a sole proprietor, your loan application is not based on payroll costs, but it's your self-employment income that's going to come from your Schedule C that's attached to your tax return. And so whether you're on unemployment or not, that really should not impact the PPP application as far as I can tell. So I don't know that it's an or situation. I think you can still apply for unemployment. It just might be that if you don't have any earnings in that 8-week period after the loan, then potentially none of the loan would be forgiven. But you may have some earnings during that period. So I think it really depends upon how significantly your business has been impacted. And if you don't think you're going to have any cash collections over that 8-week period, then it's unlikely that any of the loan would be forgiven in any significant way. So hopefully that answers the question.
Great. I didn't see that last question in the chat, so I'm not sure.
I didn't either.
where-
No.
Oh,
You
it's
did.
it just actually says privately. So
Oh, there you go. So we can unmute everyone, or you can unmute yourselves if you have any questions that you want to chime in at this point.
That was my
Hi,
question.
I have a question about, I'm a sole, close to sole practitioner with one employee who works on average 24, 25 hours a week. So it's less than one FTE by that calculation. Would that be a problem, or as long as I keep her on at that same percentage, is that going to be forgivable?
Yeah, as long as you're keeping the person on to the same extent that you did during either of those base periods that we talked about, then there should be no impact on the forgiveness calculation. So everything really relates to what happens over that 8-week period, the covered period after you get the money, and how does that compare to those 2 base periods we referenced earlier. And if you're in the same position in terms of the employee is working the same amount of hours, they're getting the same rate of pay, then in terms of impacting the forgiveness, there shouldn't be any impact to that just because they're part-time. I don't know, Rick, if you would
Okay.
add anything to that.
The other thing is that, Mark, I think, you can, it's not that you either have 0 FTEs or 1 FTE. You can have 0.6 or 0.7 FTEs. If you just have one employee that's part-time, that would be, probably about 0.6. So to Chad's point, the key there is as long as you had the same level, 0.6 pre-crisis, versus 0.6 during the crisis, then you should be okay.
Okay. The other thing, just in anecdotally, I mean, my bank basically said forget about it with regard to the self-employment income. They just didn't want to deal with the potential unknowns of how to calculate your self-employment income during that period. So they just said they weren't going to even do it, which seemed to me like, the act was designed to fund self-employed people. I thought it was surprising that the bank had the leeway to just sort of say, we're not doing that.
Yeah, it's unfortunate. The banks or any SBA approved lender are really they're the ones that have to submit the application to the SBA. So you do have to find a bank or other lender that's willing to take the application. But we have heard of banks that are allowing sole proprietors to apply. So, again, the recommendation would be to talk to your other contacts, colleagues, other banks that you might have a relationship with to see if they would, process that loan. But we have heard of banks that are doing it for sole proprietors. And again, the Schedule C is the critical document there because that's what documents your self-employment income.
And it has to be Schedule C from 2019. Like I had a fluctuating up and down like a lot of sole proprietors do.
Yeah.
2018
Yeah, most of the
was
banks that at least that we're talking to are asking for 2019.
Okay. All right. Thank you. That's all my
Chad,
questions.
Chad, do you know if they're accepting, drafts of a 2019 Schedule C or does
Yeah,
it?
we have done that in certain situations is just issued a draft.
Yeah.
Yep. There is a question in the chat on if staff are on the COVID-19 leave and taking 2 weeks at the 2/3 pay, how does that affect the forgiveness? And so ultimately, if you are claiming the payroll tax credit for those wages that you're paying to those individuals that are taking the COVID-19 leave, that payroll tax credit amount that you're claiming will offset some of the forgiveness. So again, we are waiting for the guidance from the SBA to confirm that, but that is the current thinking, is that any payroll tax credit, and you think about it, it makes sense. You're not paying that payroll because that payroll is being funded through a Social Security tax credit. So it's not going to enter into the payroll cost that you're paying if it's during that 8-week period. Then we have another.
I think that it also could affect reduce the amount of loan that you actually get as well.
Depending on when they went out.
Right.
Yep. So there's another question. Could you clarify how to calculate your FTEs? Is 32 hours a week the minimum to count? So we don't know the answer to that yet. We're still waiting on guidance. But we've heard 30 hours, we've heard 36 hours. So we don't know what they're going to use. And so at this point, what we're recommending is that you use, whatever you think makes the most sense based on what your company policy was prior to this. So if you considered somebody full-time, if they were working 32 hours a week minimum, then you go with that calculation for now, just recognizing that it could change. We don't think it'll go any lower than 30. So I think 30 is the minimum that it would go, but it could go higher. We don't think it'll hit 40. So it might be, 36. So hopefully that gives you at least a range to use as you're doing the calculations.
Chad, can I ask a follow-up to that?
Sure.
So does that mean if you've got someone working, when we calculate FTEs, we would normally take, add up our people that are 32 hours, add up the 40, divide by a full-time person to get a fractional amount of FTEs. But you're saying whatever this number that we get clarified, if someone's 32 hours and they say 32 hours equals full-time, they're 1 FTE instead of 4/5 of an FTE?
Correct.
Oh, okay. That would be helpful then.
Yep.
Thanks.
Sure.
I had another question about the self-employment income versus the payroll. If one bank says, well, we'll do it for the payroll part, but we won't do it for the self-employment part, could you go to another bank and do a second application for the self-employment part if they were willing to do that, or do you only get one shot at this?
No, you can, because the way the rule is written is that companies can apply. And then, so I'm assuming that your Schedule C has a separate EIN number. Is that correct?
Separate from the company, or
From
separate from the
your
social?
Social Security.
Yes.
Yeah, so in that situation, and again, you'd have to talk to your bank, but you should be able to apply for the PPP for your company. And that would just be the payroll cost for your one employee. And then as the sole proprietor, you should be able to also apply under your Social Security number as a Schedule C.
Oh, okay. To a different bank. So you could have two
Well, you
different
could do
loans.
it. Yeah, I mean, you could do it either the same bank, a different bank, but yep.
Okay.
So one of the other questions was, are they going to increase the amount for this program to basically extend it since there's been such a great demand? Do you guys have any insight on that as of today?
Well, I mean, the bill's in Congress right now, and there is, as I'm sure some of you have been following it, so the Senate and the House cannot agree, at least yet, on that bill. But they certainly, there is some momentum to try to increase this program because the demand has been so significant. Ultimately, I would think that they will come to some agreement at some point to expand it, but it's obviously they've got to work or negotiate some points right now. But both chambers have legislation; they just can't agree.
Yeah, and so I think it'll definitely be necessary, obviously, to keep this going with additional funding. Because if you do the math, what did I mention before? 225 billion through 6 business days means that, if you just extrapolate based on that, you're talking like it'll be maxed out by Friday or Monday. However, I actually haven't heard whether or not the pace of loan approvals has actually decreased or stayed constant during that 6 business day period. It's probably, dissipated a little bit, but maybe not that much. I don't really have a sense for that. Do you, Chad?
Sorry, do you mean the pace that the banks are submitting to the SBA, or do you mean that people are submitting to banks? Because one of the things I did last week, one of the things I did last week was just shopped around and said, all right, if I was going to go somewhere else, where would I go? And no one's taking loan applications now. Big banks, little banks, private banks, like every one of them says, we are no longer accepting, if you're not a customer here,
Well, if you're
we're no
not a
longer
customer,
accepting.
yeah.
So,
Yeah.
so I think the idea of shopping around someplace where, if you're not already there, that's closed.
Yeah, well, the only thing I would say to that, Ann, is we did have a client that actually did do just that on Friday. And they had a personal relationship with the bank, but that's not where they
Yes.
did their business banking, but somebody knew somebody at the bank. And so the bank said, yes, we'll help you out. So again, I think generally if it's just a commercial relationship, I would agree with you, but there are still situations where a personal relationship or some other negotiation could help you get in if you're not having success with your current bank.
Yeah. If you know somebody, basically.
Right. There is a question here. Is there a process or a worksheet that you could recommend to calculate payroll for staff over 100,000? I would certainly work with, your CPA firm or your current advisor to do that. But I think really all you would do for purposes of the forgiveness is to, for now, calculate everybody based on how you pay them and make sure that nobody is exceeding that $100,000 cap versus on whatever frequency that you pay. So what I mean by that is if you're paying bi-weekly, if you take $100,000 divided by 26, the most that you can pay on a bi-weekly period is $3,846 per person from the loan proceeds, based on current guidance. So, I would just create a spreadsheet for each person. And for those people that are over the 100, cap them at that in terms of what you're using the loan proceeds for. And then if you're paying them more than that, just make sure you're using other funds to do that. If somebody's close, then, again, just keep that cap in mind. And if they're paid weekly or they're paid bi-monthly, just adjust, those amounts, keeping the $100,000 cap in mind. But you don't have to worry about the medical, dental, or 401k pushing them over. That's not part of the $100,000 cap. It's straight salary costs.
Right. And by the way, and Shelley had mentioned that, their benefits, whether the medical 401k match or disability pushes them over the threshold, I don't believe that disability is part of payroll costs.
Right.
Just to keep that in mind, Shelley. It seems like it seems like you should be able to, but that's not in the definition.
Right. Yeah, the act just says healthcare. Now we've taken the position, and most other advisors that we've talked to agree that it's health, vision, dental, everything that's around health, but disability is separate from that. So they may come out and say disability is included, but as of right now, we're not including that. So there is a question, does it seem like it would be permissible to give all staff a bonus during the 8-week period to make sure you reach the 75% number? So, what we would definitely say that I think all firms really need to take into account, and this goes back to the application that you filed. So there was a box on that application that you were required to certify that these loans are necessary for the ongoing operation of your business. So what that means in practice, we're going to see as things play out. But the one thing that I would really caution every firm on is this is probably not the time nor the year where you want to issue significant bonuses to owners. Because if you're applying for this loan program, you're applying for the forgiveness. If you then also have significant bonuses to the ownership group that takes them significantly over that $100,000 cap, you just have to think very carefully about that before you do it, because it could call into question whether these loans were necessary for the ongoing operation of the business. So I'm not saying you can't do it. I'm just saying you really want to talk to your advisor and think really hard before you make some of those decisions. But I do think that's a different calculus for non-owners and employees, and specifically, some of the junior level employees. And so we're still waiting for the guidance to come out, but I really don't see at this point any reason why you couldn't give a bonus to some of the junior level staff if otherwise you wouldn't be able to max out the loan forgiveness. If they're the ones getting the money, and it's going to help you get the loan forgiven, then, in a way, I think that's a scenario that you should run through, talk to your CPAs or financial advisors about. We're certainly talking to our clients about that and running some different scenarios. And so I do think it's something to think through, and hopefully within the next week or so, we do get that guidance from the SBA that clarifies some of these open questions.
And there
So-
seems to be new guidance that's coming out as part of those FAQs on the Treasury website almost every day. So,
So hopefully that at least gives you something to work off of, while we're waiting for that guidance.
And it seems like if you had reduced someone's salary, you could bring it back up during this period, right? So if you've cut somebody 10 or 15%
Right.
below, who are staff, not owners, and below the $100,000 threshold, you could use this money to restore essentially their wages, right?
Absolutely. Yeah. And again, I think you only really want to do that or consider doing a bonus to the staff if it's because if you didn't do it, you wouldn't hit the forgiveness cap. If you're already going to hit the forgiveness cap without restoring or without bonuses, then I think the decision's a little harder, because you have to really look at what is your cash flow projections through the end of the year. And that's hard with all of these projects that have gone on hold, stop. So I think that's a different judgment that you have to think through. But if you're not going to hit the forgiveness cap, just because of the way the calculations work out, then I think that's certainly something to look at, to see if that makes sense for your company.
All right. Well, we've hit our 1 o'clock time. I think we've answered all the questions in the chat. I just wanted to say thank you so much to both of you for being here. It's
thank
really
you.
been
Thanks for having us.
a huge help for our firm and for myself, and hopefully for everyone on the call today. And for everyone else, thank you so much for RSVPing through the BSA. Stay tuned to their website. They're doing more and more of these Zoom meetings, which I found so helpful and informative. And I'd really encourage you to share the word with your colleagues that these resources are available too. So thank you all very much. And yes, I will ask Susan if she can send out the recording to everyone who attended.
Great.
Thanks.
Thank you, everyone.
Okay,
Stay
thank you.
safe. Bye-bye.
Thank you.